You may have seen videos from the YouTube channel Kamikaze Cash or Mikey Millions. He's primarily an options trader and educator and has some great videos showcasing beginner and intermediate option strategies. I really encourage you to go check him out. Recently, I was on a portfolio reveal watching spree and I stumbled onto his video. It's an almost 2-hour live stream where he broke down his option strategy and revealed his portfolio. So this is the video that I'm referring to right here, the portfolio reveal and roll strategy demonstration. So in this video, it was entertaining and informational, but about halfway through, I was intrigued by something he said. In this video, he said he really liked the stock QYLD. He said that he's going to essentially hold on to it forever and has been recommending it to his friends and family. I thought, wow, this must be something really interesting. In the video, he briefly mentioned what it was, the QYLD, and that got me interested, so I researched more. However, once I started digging in, there was a big problem that I have. I don't think this is something that I would recommend to my friends and family. So let's go over QYLD and why I think it's not a good investment decision for most people. So what is QYLD? This is a covered call ETF. So the fund holds 100% of the stocks in the underlying NASDAQ 100 index. It will then sell short-term expiring call options at the money and then collect that options premium. So this is what they pay out for you for that 12% high yield. So let's go ahead and take a look at that. So here's the fact sheet. And you can see assets under management, 4.5 billion. Total expense ratio of 0.65, so it's a little on the high side. There's definitely higher expense ratios, but something to keep in mind. And then that staggering 12-month trailing yield of 12.475%. So one interesting thing about this is that distributions are made monthly and it's been ongoing for the past 7 years. So right here, the key features, QYLD seeks to generate income through covered call writing, which I already explained, and produces higher than average yields in the period of volatility. So looking at the top 10 holdings, we can see, like I mentioned, mirrors the NASDAQ 100 and pays that very high dividend yield of 12.47%. So that's very high, and it's a lot greater than you'll get on something like the sub 2% on the S&P 500, or even some of the dividend favorites like your AT&T. But this brings me into my first problem with this ETF, is this expense ratio of 0.6. So in theory, you could actually do this yourself and write your own covered calls, but it's going to take a lot of work. And actually in Kamikaze Cash's video, one of his viewers did call that out, and I agree with the sentiment of what he said in response, is that it alleviates a lot of work that you have to do with yourself. I mean, who wants to track hundreds of options and be buying and selling them? I don't know. Maybe I would be interested in it, but it's going to be very time consuming. So my next problem with this fund is the high turnover rate. So let's go ahead and take a look at that here. So we have, I'm here on Y charts, and we see there's a turnover rate of 27.87%. So that's definitely high. That's up there in terms of turnovers. And my problem with this is that more taxable events will happen the higher this turnover rate. So a turnover rate of 100% means that all the stocks in the fund are being bought and sold in 1 year. So that's something to keep in mind. And there's other tax issues along with this fund. The taxes are very high. So let's take a look at that. I was looking at this tax primer sheet. So if you can see this here, it talks about how you'll be taxed with the distributions. So here, 85% was treated as ordinary income or short-term capital gains. 3% was treated as long-term capital gains, and 12% was treated as return of capital. So you have a bit of a mix there about how you're going to be taxed with the returns, but 85% of short-term capital gains. So you'll have to be conscious of how you'll be taxed with these returns. And that leads into my first piece of advice. If you are going to invest in this fund, definitely put it in a retirement account. So my next problem with the fund, and really most dividend paying ETFs or stocks is that you don't get to decide when you take that out. If it's not a good time for you, if the market's down, if you don't need the money, you still have to take those distributions. If it's in a non-retirement account, and then you'll be taxed, even though you might not want that money. The one advantage that this fund has is that it pays out monthly, which is kind of unique. Most stocks pay out quarterly. So that's one issue. I mean, it's somewhat negated with the monthly payouts. That is nice. But really, you're going to be losing value on the upside with these covered call ETFs. Sure, you'll get the nice yield, but you're still also getting all of the downside risk. So if you're selling these options at the money, you have effectively capped your gains to just the options premium that is being collected when these options are sold. But you still partake in almost all of the downside risk. So if the stock drops, you still experience that, but you don't get the unlimited upside that you get if you just hold the underlying stock. So, I mean, this is somewhat mitigated because when you sell covered calls and the stock drops, you still get to keep the premium. So you have a little bit of cushion there, but really, I don't think personally it's enough to offset it. So should you invest in QYLD? If you do, realize that you're not going to have any gains, but you will be getting a nice hefty dividend payment. And if you might be the type of person that would want this, if you just want income and you really don't care about appreciation. So if you can't tell from this video, I don't think QYLD is a very good investment. So you might be asking, well, what would I recommend instead? And let's take a look. So here I did a back test of the portfolio. So here we have QYLD compared up against just holding the QQQ fund. And I put that up just for fun against the S&P 500. So we started with an initial deposit of $1,000 and a monthly contribution of $100. So if we scroll down and go ahead and look at the performance, you can see we have data starting from 2013, and they're pretty close, but definitely within the last year, the QQQ has been pulling ahead. But if you just look here at the compound annual growth rate of QYLD, 43.50% versus the S&P 500, 48%. And if you just held the underlying QQQ, you'd have a 55% compound annual growth rate. So for me, I don't think it really makes a whole lot of sense to invest in this QYLD unless you really just for some reason need the income. Because as you can see, the overall gains that you're going to get are going to be far greater if you just invest in the S&P 500 or the QQQ ETF. And really, to me, that's what it comes down to. I don't care how I get the money, whether it's dividends or stock appreciation. I'm just looking for the highest return that I can get on my investment. And I don't think that QYLD will do that for you. Well, there you go. I hope you found this video useful. Let me know in the comments down below. What do you think of QYLD? Is this a great passive investment tool, or are you just better off buying the QQQ? Thanks for watching.